Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. One of the hottest topics in the wealth management space over the past decade, or really even longer than that, has been cryptocurrencies, particularly Bitcoin. It seems like everyone has some type of opinion regarding the digital currency, whether you're a skeptic like me or a crypto bro flaunting his newfound wealth as it shoots to the moon. While it has been a polarizing topic, it has been one that has gone mainstream and one that cannot be ignored. We are about to embark on a new and important path within the Bitcoin journey. And so, with that, I'm very excited to have on a very influential and perfect guest on to discuss all the happenings within Bitcoin recently. But first, today's episode is sponsored by the award winning Zephyr, which helps advisors, wealth managers, financial analysts, and investment professionals make more informed investment decisions. I'm honored and very excited to welcome Ric Edelman, who is the founder of the Digital Assets Council of Financial Professionals. Ric is also a New York Times bestselling author, host of the popular Truth About Your Future podcast, and is a leader in one of the most influential figures in the financial services industry who has racked up numerous industry awards over the years. Thank you so much, Ric, for coming on the show. It's really truly an honor to have you on and such an exciting time, an important time to talk about Bitcoin. So can you please tell us a little bit more about yourself and DAC-FP or DAC-FP?
Ryan, it's a pleasure to be with you. Thanks for the invitation. My involvement in Bitcoin goes back to 2012. As a really precursor to that, the reason I discovered Bitcoin back then or was introduced to it is because of my decades-long involvement in the area of futurism. As a financial planner, my goal has always been to help our clients figure out what's coming next, to give them the advice that they need for the future that they're going to find themselves living in. And that's why I've written now 13 books. As you mentioned, probably the best-selling author in the financial space of any financial advisor. And our focus has always been on what's coming next. And I've spent a lot of time in the world of exponential technologies, nanotech, biotech, bioinformatics, 3D printing, big data, fintech, edtech, agtech, neurosciences, and so on. And all of that led me along the way to meeting Ray Kurzweil and Peter Diamandis, among others, both of whom co-founded Singularity University. I went through that program back in 2012, and that's where I was introduced to Bitcoin.
Okay.
This newfangled idea of digital money. And my reaction to it was, I think, the same as everybody's reaction when you first heard about Bitcoin. Huh? What? It didn't make any sense. I didn't get it. But rather than just dismissing it out of hand as a novelty or something silly, I figured there are some pretty bright people talking pretty excitedly about it. I don't get it. So maybe I need to figure out what is going on here to determine for myself if there's a there or if it is truly a novelty. So I spent much of 2013 studying, learning, reading, talking with others, and concluded pretty quickly that digital assets and blockchain technology, which makes them possible, is the most transformative technological innovation since the internet for global commerce. The other thing I realized is that the financial services industry was largely oblivious to this issue. And so I began my efforts to educate both myself deeper and also to educate fellow financial advisors in the financial services industry, because we all know that we missed the internet. None of us invested in it. And we all regret and lament that we had the opportunity to buy Amazon way back when, and we failed. We didn't do it. We didn't buy Google. We didn't buy all those wonderful FANG stocks of today when we had the chance, because we didn't understand the internet back in the 90s. We got chastened by the dot-com bubble bursting in 2001. And I'm determined not to miss this one. Blockchain technology represents Internet 3.0. It's
Mm-hmm.
simply the next evolution of Internet technology. And we blew the first one from an investment opportunity. I don't want to blow the second one because this represents the greatest investment and wealth creation opportunity of the 21st century. So in 2015, I created DAC-FP, the Digital Assets Council of Financial Professionals, to teach financial advisors and their firms about this new technology to help you understand it so you can decide whether to incorporate it into your clients' diversified portfolios, and if so, how to go about doing it.
Mm-hmm.
That is fully compliant with regulation, that is in the client's best interest, that facilitates easy adoption by the firm without having to go through a lot of difficulty or challenge of building a new tech stack or retraining staff. And so we have created a wide variety of training programs. We do webinars, live conferences. Our big claim to fame is that we created the CBDA, the Certified in Blockchain and Digital Assets professional designation. It's listed on the FINRA database of professional designations. Thousands of advisors and back office personnel have completed the program from 37 countries. It's the oldest and largest program of its kind. I just believe that it's important not just to deliver this for the clients I happen to be serving. You know, I built the largest RIA in the country, as most people know, Edelman Financial Engines, which is the number one ranked advisory firm in the nation by Barron's now 6 years in a row. I was named the number one independent advisor in the nation 3 times by Barron's. And so my goal is to help the industry move forward. I'm no longer running Edelman Financial. I'm no longer serving clients or managing assets. My role is kind of like the elder statesman, where I'm just trying to help other advisors and other firms understand this newfangled thing called crypto so that we don't miss this opportunity the way we've all missed out on the internet.
Yeah, great, Rick. That's such a great backdrop to this conversation. Going back to a couple, do you think number one is, like I said, I'm kind of a skeptic. When I say skeptic of crypto or Bitcoin, it's not so much, I don't think, a skeptic of the theory behind it. It's more about the valuations, right? And a lot of that, I wonder, maybe other investors out there, they still have that bad taste in their mouth from the dot-com bubble
Sure.
bursting.
Mm-hmm.
Do you think maybe that might make some people hesitant about investing in Bitcoin, as they still think, gosh, we've done this before? Is this another version of that bubble?
Well, I think there are lots of reasons why people are skeptical. First of all, you're trained to be skeptical. You know, we're supposed to be on behalf of our clients. That protects our clients from us being careful about the investments we recommend. So it's healthy that we are skeptical. That's different from being in denial. A prudent professional advisor does what I did. I don't get it. Let me learn more.
Mhm.
I love Abraham Lincoln's famous quote. He said, "I don't like that man. I must get to know him better." So if you hate it, dig into it to validate your hate.
Mhm.
You might confirm it, in which
Right.
you've made the right decision, or you might surprise yourself and discover there's something else to it that you didn't fully understand in the beginning. That's my challenge to advisors. I put crypto in the same category as annuities. We all have strong opinions about annuities. We love them or we hate them. We use them or we never do. But every advisor fully understands annuities. They know how they work. They understand the taxes. They understand the difference between the owner and the beneficiary and the annuitant. They can explain to their clients why they feel the way they feel about annuities.
Mhm.
My challenge to advisors is do the same thing with crypto.
Yeah.
If you can't explain what Bitcoin is to a client, then how can you justify hating it? So that's all I want to do is make sure you have the fluency so that you can make an educated decision. Whether you buy it or don't buy it, I don't really care. I just want you to know what you're doing so that you're doing your job for your client. So let me elaborate for you, Ryan, on to why the healthy skepticism exists. You mentioned one, we were burned through the dot-com bursting bubble. We don't want to go through that again for our clients. That's healthy. That's reasonable. Bitcoin's price volatility sure looks like a tulip bulb. Insane price volatility, right? Up 1,700% in 1 year and down 84% the next. 7 times Bitcoin has fallen 70% or more in a single year. Who wants to tolerate nonsense like that, right? That faddism, like Beanie Babies and tulip bulbs, is a good reason to be skeptical. Third, we've had an incredible array of fraud. Most recently, FTX and Binance, but going back to the 2012, we had Mt. Gox. We've had Silk Road. We've had a variety of scandals and scams and frauds and business collapses in crypto over the past 13, 14 years. All of that raises real skepticism among advisors. I get it. Why would you want to take the risk of being wrong and embarrassing yourself, and worse, losing client assets? So I get all of that. What we need to recognize, however, is what are the causes of those things? How can we engage while protecting ourselves against those things? And is it worth it in the first place to even bother? And what I come down to is that we don't really have a choice but to engage. And the reason we don't have a choice is because this is a legitimate asset class. It's the first new asset class in 170 years. The last time we had a new asset class was the discovery of oil in the 1850s. So this is new and different, as oil was, and it's as transformational as the oil industry has been. So it's not going away. 450 million people around the world own Bitcoin, including 52 million Americans, including, among those Americans, a lot of your clients. So if you think your clients don't own Bitcoin or they're not engaging in crypto, I'll tell you something. Your clients are buying Bitcoin the same way your teenagers are drinking beer. They just don't want you to know. Because you haven't raised the conversation. You may have said something dismissive or negative, and they're afraid to mention it to you. I encountered a guy a few weeks ago who told me that he owns Chainlink, and he's owned it for years, and he hasn't told his advisor. He said, because my advisor will just tell me to sell it, and I don't want to. So the advisor has abdicated their responsibility and the ability to help the client with tax planning, estate planning, intergenerational planning. This is our job as financial advisors, not to take a philosophical stance on whether we like or don't like an asset. If you believe in portfolio diversification, you already own assets you don't like, because as a diversifier, we own everything. That's the whole point. We understand that some investments go up while others go down. And that's how we benefit from modern portfolio theory, the efficient frontier. We get the purpose of rebalancing, dollar cost averaging, and tax loss harvesting. Well, Bitcoin, with its incredible volatility, is a stock on steroids. We tell our clients how to handle volatility, so maybe we can tell them how to handle the volatility of crypto, put it to use. If crypto's price performance doesn't operate the way that stocks or bonds or real estate or gold or oil do, it becomes an enhancement to a diversified portfolio. These are the kinds of things I've learned over the past decade, and the kinds of information that we share, that we can actually improve the client's risk reward measurements by adding Bitcoin to the portfolio rather than avoiding it. We actually make the portfolio safer and better performing, which is counterintuitive. Who would ever think that that's the case? And the question then becomes, how do you allocate? How much do you allocate? What types of crypto products do you buy? How do you handle the compliance and record keeping? How do you explain it to clients? These are the key practice management issues that really, really matter. Even if you never recommend Bitcoin, one of my most popular courses is called How to Build Your Business with Bitcoin by Hating It. It's not a question of trying to persuade you to buy Bitcoin. The issue is helping you understand how Bitcoin works so that you can go to your clients who already own it, and you can now help them with the personal financial elements of this, which is your job as a financial advisor. So, yeah, I get the skepticism. We've just got to set that aside and not let it interfere with our efforts to obtain education.
You're exactly right. There's a lot there to unpack. I think number one is, we're going to discuss about this later, but about modern portfolio theory. It's one of my talking points here, but there is so much there to uncover. And I feel as if, prepping for, this call, I really looked into DAC-FP, and I'll tell you what, after this call, there's probably a very highly likelihood that I'm going to be signing up for one of your classes, because that's the best thing I can do, is just educate myself. And you're talking about financial advisors doing their due diligence, and being unbiased as a financial advisor is probably one of the best things they can do, so they can just educate the investor on the risks or rewards of an investment. And I think that's one of the primary things with crypto, is just understanding it, so you
I
can
think you're
educate.
absolutely right. I'm excited to hear that you'll go through our course. You'll really enjoy it. You get 18 CE credits.
Okay.
We need the CE credits anyway, and I don't think we need another annuity webinar. So let's go learn something for once in a while.
Yeah.
That's on a new and different subject. So the course is really exciting. It's world class faculty. Scott Stornetta, who's the
Okay.
co-inventor of blockchain technology, is on our faculty. Anders Bronworth of the Boston Fed is on our faculty. It's a terrific program. People rave about it, and I'm sure you'll really enjoy it. The really fascinating thing of this is that we're not, like I said, we're not trying to teach you or persuade you to buy Bitcoin. I don't care whether you buy it or not, but I want you to be able to serve your clients,
Mhm.
and that's what really matters. And what you'll discover uh, through this coursework is the price history of Bitcoin relative to the other financial markets, how it improves the Sortino ratio, the Sharpe ratio, standard deviation, max drawdown. It aids and improves your ability to give your clients a risk managed, diversified portfolio. It lets you do your job better, especially since your clients already have an interest in this. They're curious about it. We have Bitcoin ETFs that we're all anxiously waiting for to be coming in January. And you're going to see a massive amount of marketing and advertising by those fund companies in their effort to gain market share. So your clients are going to be bombarded by the ads. They're going to call you and ask you, what is this? What's going on? Should I buy? Which one? How much? You need to be able to answer the questions.
Yeah, you're exactly. Let's talk about the ETFs real quickly. You know, it's arguably the biggest story, not just in crypto land, but financial services industry. And you meant, January 10th is that date, right? When the SEC, we're all assuming, I think, approves the Bitcoin ETF applications. I believe there's 12 applicator or 12 firms,
13 now.
13 firms.
Mm-hmm.
And you talked about which one. That would be my question. You got 13 ETFs, at Bitcoin ETF, spot ETFs. Well, how do you differentiate them? As a financial advisor, I'm looking at 13. What one do I pick? Expense ratio, or
So
where do
you're
you?
right. This is a single asset ETF. And it sounds kind of crazy. I mean, there isn't a financial advisor in the country who would tell his client to buy only Apple stock, right? That's why we give our clients the S&P 500. It's why we give them a variety of stock ETFs, large cap, small cap, US, foreign, growth,
Mhm.
value. We believe in diversification, et cetera. We know that not all stocks perform the same way at the same time, so we diversify. And yet this Bitcoin ETF is just Bitcoin. It doesn't have Ethereum, it doesn't have Polygon, doesn't have Solana, it doesn't have Chainlink, doesn't have any other digital assets. It's only got Bitcoin. And you've got 13 fund companies that are all going to be launching, probably approved on the same day by the SEC, no later than January 10. It can come sooner. So how do you pick among these 13 different fund companies? There are basically four things that make them different. They are all buying Bitcoin and only Bitcoin.
Okay.
So here are the four ways they will set themselves apart from each other. Number one, who's their custodian? Where are they storing and safekeeping the Bitcoin that they bought? There are only a few custodians that these 13 fund companies are going to be relying on.
Okay.
Coinbase and BNY Mellon are the
Okay.
two biggest. Who is their surveillance partner? As part of the effort to approve these, the SEC has been very concerned about how they value, what's the NAV of the fund? How do you price Bitcoin? It's easy to price IBM shares
Yep.
because we all agree on the price of IBM. It's only available in one place, the NYSE. Everybody is in agreement. Here's the price of IBM at any given moment. But what about Colgate toothpaste? Safeway sells it for one price in the supermarket. 7-Eleven sells it for a different price. So what's the price of Colgate toothpaste? Depends on where you go and who you ask.
Right.
The SEC doesn't like that about Bitcoin. This is a global asset, trades 24/7, and different exchanges around the world have different prices for Bitcoin at any given moment. The SEC doesn't believe that it's fair, that it's in the consumer's best interest. So the industry has created a solution called surveillance, where they are going to partner with an independent third party who will surveil the crypto marketplace and determine what the price is at any given moment. And so the fund company will not be making that determination because they're not an independent party. They've got a conflict of interest. So by using an independent third party, the most common that are going to be used are Coinbase and CBOE. So who is the surveillance partner? Who is the custodian? Third, how is the fund going to be actively managed or passively managed? If it's passive, they're just going to buy Bitcoin and hold it, right? But if it's active, they may increase or decrease the allocation to cash.
Okay.
At any given moment, they may go to cash if they think Bitcoin's going to fall, or they may go fully 100% if they think Bitcoin's going to rise. So do you want an actively managed fund or a passive? You have that same question with all of your assets, right? And it's a big common debate with advisors. So third is active versus passive, and related to that, cash allocation. And then finally, fourth, as you mentioned, the expense ratio. Different funds are going to charge different fees. So are you going to go with the low-cost provider or are you going to look at the other three levers? What I think investment advisors are going to do, what I think they really ought to do, since advisors are new to this, don't pick one. Pick two or three or four. In other words, diversify the position. Choose a couple of different Bitcoin ETF providers, one that's active, one that's passive, one that uses this custodian as opposed to that custodian. This way, if something does go wrong and it does blow up, you don't have all of your money in one place. So let's try to reduce the risk from what is inherently a very risky thing to do.
Yep.
So I think that advisors need to learn about these differences. We're going to be doing on my podcast a series as soon as these ETFs get launched. We've already got 6 of the 13 confirmed. Every day for a week or two, we're going to be doing an interview with each of these ETFs.
Okay.
So that you'll be able to join the podcast and listen to these fund managers describe their funds and help you understand how they're different, how they're better than the competition, so that you can decide better which of these you want to work with. So you'll want to stay in touch with us at DAC FP for that podcast video series, because we're going to be launching it as soon as the SEC approves them.
Interesting. Yeah, that's going to be a must watch, I believe. We talked about come, January 10th or potentially before then. I can't imagine, once they're approved, they're, in Bitcoin, one of the hardest things I get around is, like you said, valuating it. What's the valuation of Bitcoin? It's not like you can do dollar cost, any modeling or anything like that. It's supply and demand for the most part.
Well, you're right. It is supply and demand at the end of the day, just like anything else. But there are ways you can use financial modeling to arrive at a price for Bitcoin. Okay. And in my book, The Truth About Crypto, which was a New York Times bestseller, debuted at #1 on Amazon, we have an entire chapter devoted to crypto valuation to show you the different ways that you can value this. But this is where a lot of advisors' heads explode. Jamie Dimon says Bitcoin has no intrinsic value. Warren Buffett calls it rat poison squared. So when very intelligent guys like that say such things, why would anybody go anywhere near this? And here's why everybody's heads explode when they try to come up with a legitimate value of Bitcoin. The problem is that it's literally round pegs and square holes. We are taking all of our knowledge, experience, and expertise about the investment world, where we have a lot of training and knowledge on how to value assets. We know how to value a stock. We've been doing it forever. We're good at it. We're trying to apply that metric to crypto, even though crypto is a totally new and unique asset that has nothing in common with stocks. For example, in the world of stock valuation, what do? You look at the company, you look at the product, you look at the management, you look at the employees, you look at the competition, you look at the regulation, and you look at all of these metrics to come up with a comparable on other stocks in a similar industry to arrive at a multiple.
Yep.
Based on the number of shares and the multiple, you come up with a share price. Makes sense. This is how Warren Buffett got rich. Apply that to Bitcoin for a moment and look what happens. Bitcoin is not a company.
Right.
There is no product. It has no employees. There is no competition. All of those numbers are zeros. There's no profits. There's no revenues. You have to reach the answer that Jamie reaches. There's no intrinsic value. All the numbers are zeros. That's because you're using stock market valuation for crypto. You have
work.
to use a different type of methodology to come up with a realistic number. So the short answer is this. We could argue over whether or not Bitcoin has any value, but I'll tell you this, it certainly has a price. And right now that price is around $41,000 as we record this. So it's supply demand at the end of the day. And we are anticipating, due to the new ETFs that are expected, a massive increase in demand.
Yeah, that's what I was just going to comment. You can't ignore that increase in demand is going to surge come January 10th or whenever that date is. I mean, Bitcoin right now is the highest performing asset class year to date. It's roughly over 140% year to date performance. And starting off 2024, I think you're going to see another big surge, whether you like it or not, because of the demand in the ETFs and these providers having to buy. And
let me put some numbers to that, Ryan, for you, because you're absolutely right. Let me just give you a small illustration of why we believe this demand is going to translate into a significant increase in price for Bitcoin. Just look at the narrow sleeve of independent financial advisors. That's the channel I come from at Edelman Financial. We're the largest independent firm in the nation. Collectively, independent advisors manage $8 trillion in assets. Okay. Forget about the wirehouses, forget about the institutional investors, set aside the family offices, put aside pensions and endowments and sovereign wealth funds. Just look at the independent RIA channel, 8 trillion. All the survey research tells us that about 75% of advisors in this channel say they have not been recommending Bitcoin to their clients because there has not been an ETF, but they will recommend the ETF when it becomes available. And that their average allocation will be 2% of assets. Okay. $8 trillion times 75% times 2% is $150 billion for an asset class that has a market cap of about 800 billion right now. We're talking about a massive increase in asset flow into this asset class with a fixed supply. And that doesn't include the institutions or anybody else engaging. So for that reason alone, the flood of new money into the asset, it's like everybody clamoring for Stevie Nicks tickets. Or Taylor Swift tickets. There are only so many seats in the stadium, and if everybody wants them, the prices of those tickets are going to skyrocket, and that's what we're going to be facing with Bitcoin over the next month or so.
Right. Yeah, and that right there is perks my interest too. It makes me like, okay, I really need to understand Bitcoin more. The basics and stuff, but the basics at a lot of times.
Here's what it comes down to. Ryan, here's the real question. In the past 5 years, if you were going to recommend Bitcoin to your client, someone would say to you, maybe your client, maybe your compliance officer, maybe the SEC, would say to you, why are you recommending Bitcoin? But now the question is inverted. Why aren't you recommending it? And you've got to have a better answer than, I think it's a fraud or a fad. Yeah. Because that answer ain't going to cut it anymore.
Right. That's a very good point. Let's talk real quick. Last topic here. You talked about modern portfolio theory, and really that kind of hits home to me. Building diversified portfolios. Recently, a few years ago, I built the efficient frontier with standard equity, fixed income asset classes, equity asset classes using Zephyr. And I included Bitcoin. This was a couple years ago. And at the time, I was, this was a few years ago, I was very skeptical of Bitcoin, but it opened my eyes to results because every portfolio along that efficient frontier included some percentage of Bitcoin. Mm-hmm. And as you got more conservative, now that percentage was very small, it was less than 1%. Mm-hmm. Updated that same thing last week. right? Every portfolio along that efficient frontier. And I believe the largest Sharpe ratio of all those portfolios, or that optimized portfolio, had over a 5% allocation to Bitcoin. When I did that, it really opened my eyes. And so it does, you mentioned it earlier, it does enhance a portfolio. It increases diversification.
Mhm.
When we talk about that, and I know every situation is different based on the investor, what type of allocation do you think would be kind of a good earmark to Bitcoin for a typical portfolio?
In my book, The Truth About Crypto, I advocate a 1%
Okay.
allocation. The primary reason I do that is because, number one, this is new for most people, both advisors and their clients. A 1% isn't threatening, it's not scary. If it blows up and goes wrong, you're not going to hurt your client's financial future. No harm, no foul. But if it works, and you have Bitcoin's outsized returns like we've had this year with 140% gain year to date, a 1% allocation can have a material improvement on the overall
Mhm.
portfolio. So 1% is an easy,
Yeah.
safe to get in the water kind of approach. Yale did a study. Their conclusion was 3.1%
Oh,
should be the optimal allocation. The CFA Institute did a study. They said 2.5 to 5% is the optimal allocation. So everybody who studies this is in pretty much agreement, low
yeah.
single digits.
Yep.
Nobody's talking about 20, 30, 40, 50% the way we do equities. But the only thing I can tell you is that the wrong answer is zero.
Interesting. So then when you do construct this portfolio, where would you take that 1% or 2% from? Would it be equities, maybe your alternative sleeve? Is there a certain spot you take that 1% or 2% from?
I'm not terribly concerned whether you call it equities or alternatives. Clearly not from the bond portfolio.
Right.
I would take it from either equity. In other words, if you have 60-40, I would do 59, 40, and 1, or
Okay.
58, 40, and 2, or 57, 40, and 3. If you're going to create an alternative sleeve, sir, you could take it from the emerging markets category. You could take it from the alternatives category. I don't. I think that's a nuance, and each advisor will decide for
Yeah.
themselves based on how they construct portfolios. I don't think it matters a whole lot how you define it, as long as you're consistent in your definition.
Yeah. Do you think advisors are prepared in general for the potential approval of the Bitcoin ETF?
No,
No.
absolutely not. No, I think most advisors have been ignoring crypto all year long. They've been focusing on other business issues. Let's face it, we got a lot going on in this world. And very distracting
Yes.
period of time between interest rates, inflation rates, the geopolitical environment, which is horrific, the political environment we're in here in the US with the elections coming up. And right now it's year end. Everybody's focused on year end tax planning and year end work for
Mhm.
their clients and so on. So, no, I don't think Bitcoin has been state of mind for most folks. I think the 150% gain, 140% gain year to date has caught people by surprise. And many have been being dismissive of it because we've seen that game before. And we know that the big gains are followed by big losses, and they're not aware of the super cycle. They're not aware of the Bitcoin halving that is coming up in April, May. They're not aware of the new legislative environment. They're not aware of the development that has gone on in crypto over the past few years. They just haven't been paying attention. And they
Mhm.
haven't really been following the Bitcoin ETF story very much, nor have their firms. Their firms have not prepped the advisors into saying, when these ETFs become available, we're going to put one or more of them on our platform. You will be able to make it available to your client. There hasn't been training as to how you communicate to clients, how you determine which of your clients get it, how much of it they get, which ones they get.
Yeah.
So, no, I think most advisors are on their heels. They are flat footed about it. They are not agile and prepared. Those advisors who are going to be first movers. They're going to move as soon as these ETFs become available. They will be doing the best job for their clients. They will be not only delivering the better results for their clients, but they'll also be differentiating themselves in the marketplace. They'll be able to brag. I have an advisor who talks to me about something your advisor isn't talking to you about. The opportunity for referrals is going to skyrocket.
Mhm.
The opportunity to differentiate yourself in the marketplace and attracting new clients, new assets, as well as new assets from existing clients who own Bitcoin, and now they'll be able to transfer it to you for you to manage in the ETF, because your clients have been buying Bitcoin without you only because you wouldn't help them. But now you can. So just like you do all of your other clients' assets, you'll be able to attract new clients, new assets, more assets from current clients, build your reputation, improve your client service, generate goodwill, while at the same time improving your client's portfolio outcomes. What's not to love?
Exactly. I talk a lot about on this podcast about the generational wealth transfer, right? And how can financial advisors link their current older generation clients to the newer ones and keep
Right.
those assets. And one of the things that comes up is technology, embracing technology, enhancing that client experience. And one of them, is Bitcoin, because the younger generation, even the older generation, but they're going to want to, you know, have the potential to invest in Bitcoin.
Historically, children never gave parents investment ideas because they didn't have any. They weren't aware or engaged or involved.
Mhm.
But today, children are actively talking about crypto with their parents. T. Rowe Price does an annual survey. They've been doing it for 21 years called Parents, Teens, and Money. And last year, for the very first time, they asked the teens questions about crypto. They said, if we gave you $100 to invest, what would you buy? 57% said they would buy crypto. Only 32% said they would buy stocks. So kids are into crypto and they're talking actively about it with their parents, which means your competitor is no longer a broker at a wirehouse. Your competitor is now the children of your clients. Why do you want to put yourself in that kind of a competitive environment when you can instead become partners with them?
Ric, I think that's a fantastic spot to end this conversation. Real quick, again, thank you so much, Ric, for coming on the show. It really has been such a pleasure to have you on. I learned a lot. So it's just a great conversation. Where can our audience get more information about DACFP?
Real easy. Go to dacfp.com, dacfp.com. You'll find all of our events, our webinars, the CBDA designation. All of it is right there, plus links to my daily podcast, which is The Truth About Your Future, which is ranked in the top 1% of all podcasts, according to Apple. So encourage you to tune that in. That's not just about crypto, but about all the financial issues that matter to advisors today. So easy for us to reach each other at dacfp.com.
Perfect. I've listened to many of your podcast episodes. It is a fantastic resource. I love it. So,
Thank you, Ryan.
and I can definitely remember DACFP. So that'll be an easy one. Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our podcasts on the Adjusted for Risk YouTube channel, as well as on Spotify and iHeartRadio. Thank you very much and have a great rest of your week.